Hi everyone and welcome to our market update. This is the Property Trio and you are listening to Dave Johnson, Cate Bakos and myself, Mike Mortlock. Welcome aboard, guys. We've done the Christmas silly season and we've got our first print of the month that was, of course, the media didn't stop from talking about, I think, what was it, national downturns? What can we learn from their response and interpretation from the data?
Yeah, well, December's always an interesting month anyway, isn't it?
Yes.
It's always nice to get the December figures out so you can look over the entire year and get a sense of what has happened across the board over the full 12 months. So it's an exciting print, the December print.
Yeah, well, as you say, Dave, it closes off the year that was 2025, and we'll have our scorecards marked for our predictions for the year that was. Obviously, we've put our 2026 ones out there, yeah. So, Dave, give us a bit of an overview of the last 12 months. How would you categorise it, and what were the markets that you think really surprised or outperformed?
Yeah, look, it's been a solid year across the board. I think it was 8.5% annual growth. So that is the biggest capital growth, largest capital growth since 2021, which might surprise a few people. It took me by a little bit of surprise. So 2021 was the boom year of 24.5% growth at when prices really took off during COVID. Then we fell by 5.3% in 2022 when everyone was, saying for a second time that we would have huge falls in prices. 2023, we were up 8.1, 2024, 4.9, and this year, 8.6. So it was slightly stronger than I expected. Which partly was brought forward by the federal first home buyer boost coming in earlier, and that's certainly driven markets at the back end of the year. We've seen a real trend of the lower quartile prices outperforming significantly across all capital cities and the upper end struggling the most. So that's a real, that talks to affordability challenges at the top end. I think it's why we are seeing less growth on a macro level for Melbourne and Sydney, although I think those, lower quartile markets are still quite strong. So, there's a few of my views. I've been surprised again by the growth of Brisbane, Perth, Brisbane up 14.5%, Perth 15.9%, and even Adelaide to a degree, although it was a bit more tepid at 8.8%. I just can't believe how they keep going so strong. It's like those markets, Brisbane, Adelaide, and Perth. Are they just going to fly forever? Are they just the three hot capital cities that everyone's going to continue to move to and their economies are going to outperform the rest of the country? Or, is it going to run out at some point? So, look, there's a few talking points for you two to take in any direction you like, but there are a few of the takeouts for me.
It's a reasonable question, isn't it? I mean, those markets just absolutely galloped through 2025 and, they were busy in 23 and 24 as well. Cate, Dave mentioned affordability. When we look at, the month of December in isolation, we saw the regions growing at double the pace of the capitals. And across the year, we've got 9.7% growth in the regions with 8.2% in the capitals. Is that affordability story, do we think? Because obviously we haven't had the rate cuts that we might have hoped.
Look, there is a bit of affordability in there. I've got a theory on this, though. I think that we had a really interesting supply story. And if you look at the two biggest auction markets, they're not only the two biggest auction markets, they're the biggest markets. Sydney and Melbourne, they came back marginally, 0.1%. But the point is they came back after a full year of positive. We had our first negative glitch. And what we did see throughout the year were vendors getting opportunistic and getting excited. Now, in these auction markets, a vendor can't just put their property on the market and sell it tomorrow when they're taking it to auction, unless, of course, they're entertaining pre-auction offers. They have to get in the queue, they have to prepare the house for sale, they need to pick their auction date, and the agent starts the entire process, which is a well-oiled machine. But there's about 6 weeks from go to woe for an agent to tee up an auction campaign for any of these vendors. Now, what we saw when interest rates were looking like they'd come down and prices were continuing to grow were vendors saying, well, let's wait until the very end of the year. The longer we wait, the more we get. And so we had a disproportionate number of auctions scheduled for December. We had auctions all the way up to the 20th of December. And then, of course, we got our surprise inflation result. And all of a sudden, the media line pivots from expecting cuts in early 2026 to, hey, we might actually be getting a rate increase. Of course, buyers pulled back because that's what they do. We had a glut of stock on the market, and all of a sudden our supply and demand balance shifted and we saw some price falls. That's what I think happened in December.
Well, a hell of a review, and thanks for sharing that insight with us, because obviously you've been on holidays, but thinking quite a bit about the market, obviously, at the same time. It is interesting to note that CoreLogic basically is saying, despite interest rates being maybe higher than long-term average, we can take that offline, but basically saying that prices have held firm and steady because of a lack of stock, but you did sort of witness that rush in the back end of the calendar year in those auction markets.
That's right, I most certainly did. And Melbourne in particular has been a really jittery market because vendors have been waiting for 4 years to see some growth again. And so they got a bit of a sense of that, a taste of that, might I say, in late 2025, thinking there's momentum here, let's sell as late as we can. And of course, the tables turned just a little bit, but enough to come up in the data. And I think one of the best litmus tests of sentiment and what's happening on the ground is, just having a look at a busy buyer's agent's schedule. I always do a deal on Christmas Eve. I've had 16 consistent years of deals being done on Christmas Eve. This year, I did 3. And that's saying something. I took Christmas Eve off. I was busy. I had, a shopping list of ham and, roast pork and all the rest to get. And I was putting on Christmas Day. So I said to myself, this year, I'm not working. I'm not doing any deals. Of course, have a look at Instagram. I'm standing in front of sold stickers. So it was a really busy day, and there was some low-hanging fruit, some motivated buyers and some good prices. And that is, of course, what happens when opportunity increases due to this supply and demand imbalance.
Dave, we talked a little bit about the markets that were at the peak, and because of our annoying little December Sydney print and Melbourne print, like Melbourne's just gone a little bit further away and Sydney is now 0.1% from the peak. But Canberra is still slowly closing that gap, and we've seen Hobart, I think maybe a couple of episodes ago, we decided to call the bottom of Hobart. We look absolutely brilliant if this trend continues with the December figures. What do you reckon?
Yeah, hopefully we've nailed Hobart. It rose by 0.9% in December, so there's clearly, some action going on there. I had it as a smoky, maybe a third or third position, I think, maybe for 2026 outcomes. But yeah, I mean, if you look at the December figures like Cate's just talked to, a little bit of a surprise, but she's just explained her theory on why Sydney and Melbourne went backwards by 0.1%. But what really took me was Adelaide and Perth rising again, almost, I think their biggest months for the year, 1.9%, and Brisbane 1.6%, and then Darwin again 1.6%. So they started off the year with before the rates fell, struggling for price growth, and I've got somewhere a table of that month-on-month price movements of every capital city, but then they just gradually picked up momentum. There it is. So like at the start of the year, it was like, okay, the heat's got out of those markets. They'd gradually been falling in terms of their monthly growth as rates had risen. So Brisbane was only at moving 0.2% in February, for example. Adelaide was 0.3%, Perth was 0.3% in March. Perth was only 0.2%, in April was only 0.4%, Adelaide was only 0.3% in April. But then they gradually started picking up momentum from around April. And once again, we hit the end of the year and they're flying. And so that's a real interesting story about those markets and their sensitivity to affordability still, and what's happening with rates, and that certainly has given them a second lease on life this year, which has been interesting. And then Darwin's obviously been the big story, and we had a nice listener question about Darwin. We'd heard a few jungle drums beating. None of us had that in our top 3 for predictions. And that's more because we probably hadn't done the deep dive on Darwin. So we decided to do it for that episode. I think we recorded probably the start of Feb.
Yeah.
Went live a little bit after. And basically, after we did the deep dive, we were very bullish on Darwin. And that's just flown for the first time in close to a decade. So, there's
2025.
Wins 2025. Yes. Yeah. So there's interesting subplots and stories that you can learn from with each of those capital cities.
Speaking of stories and subplots, 2 of the things that you and I think, were talking about during the predictions was global uncertainty. So the whole Iranian situation has surfaced since then. And also, I think maybe the only thing that I'll get right this year is the concern that natural disasters could be a feature that impacts the property market. Obviously, we've had a cyclone at the top. We've had huge bushfires down in your state, and what that sort of says to me is that that's going to pull construction resources into rectification works and insurance works, and we've seen that happen in the past, and that is going to put, I think, a little bit more constraint on potential housing supply, which is already about 30% less than what the target was, which is maybe an out-of-date target because of the immigration numbers that we saw in the back end of 2025 and thereabouts. How do you guys see that playing out?
Well, and just quickly in terms of the global macro instability, you can't forget the snatching of the president, the Venezuelan president, and his wife in early January. So, and actually Victor Chavets, who's like a macro global analyst, highly regarded at Macquarie, he works off big thematics in terms of investing, and one of his major thematics is global instability, and he actually predicted that Donald Trump would start a small war or something to that effect. So that took about 5 days for his prediction to come true with what Donald Trump did with the Venezuelan president and his wife. So there's been a bit happening, and we're recording this on the 16th of Jan, so a bit's happening the first 2 weeks of the year, hasn't it?
Yeah, well, I mentioned Iran, but there's Venezuela, Greenland. So Cate, your observations of things like national disasters. I think you were leaning into the fact that it's not going to be a national story; it's going to be a lumpy sort of localization story.
Yeah, I think so, Mike. Like we've seen before when we've had big events, tradies will only travel so far. You'll get the odd tradie that will go interstate in FIFO for work, but I doubt that we're going to see New South Wales trades coming down to Vic or going up to northern Queensland for rectification works. But I think when you focus on places like far north Queensland, which is diverse and large geographically, but small in terms of population, that puts a really hard strain on a local market when you've got trades working on these big jobs.
Yeah, fair enough. I suppose it all depends on the pricing, right? If there's an extreme shortage of a particular trade, then the dollars will dictate how far they're willing to go, right? And I think we've seen precedents of that in, with roofing shortages in Queensland cyclones and those sorts of things. So it'll be an interesting one to watch. Let's jump on to the rents. It seems to be, if we look at houses and to a similar extent units, the markets that didn't have a big year tended to end on a positive. The markets that did have a fairly solid growth year tended to taper off as a broad analysis. Starting with you, Cate, what did 2025 sort of say to you about rents?
Well, if we have a look at houses, they're actually houses and units are almost in lockstep, which is unusual. We've usually seen a bit more volatility on units, but we've got both Melbourne and Canberra sitting within the target inflation band, which kind of suggests that those markets could be sitting at a stable kind of level for rental movement. Might I add that there's been a bit of an uptick, so that could continue. We might see next month that they both eclipse 3%. But those two are sub 3, so they're normalised market conditions by anyone's measure. The really lofty, huge swings, we've seen that calm down. At the moment, it's both Hobart and Darwin for both houses and units that are sitting at 7.6 and 9.3 respectively for houses and units. That is big, but we've had double-digit growth for the last 4 years across lots of our markets. So rents have calmed down.
David, when I look at the rents, I think about the story of potentially activity. For example, we were looking at the Perth figures when it really started to boom and wondering why rents were growing at a point where it sort of seemed anecdotally investors were piling in. But it sort of does beg that question, are we seeing a similar pattern where it's actually the transactions are resetting market rents? So if we're getting a new investor in, they're much more likely to reset the rent to market, whereas if it's established, it might have been there for 2 or 3 years and slowly sort of not kept pace as typically it can happen. Do you have a similar read?
Yeah, I think we've talked about that a couple of times, haven't we, Mike? That when a market is on fire and strong capital growth, a lot of investors buying new properties, it's surprising that rents increase so significantly at the same time. But we do think it's investors taking new ownership and then resetting the rents as the first opportunity they get. And so you have a look at the largest rental increases in 2025. Darwin had an 8.2% lift. So that was the largest of any capital city. The largest of any region was regional WA at 10.1%. Again, that's in line with a very strong market from a capital growth perspective. The smallest increases were Melbourne at 2.9% and ACT at 3%. So again, in line with lower capital growth for those two capital cities. So it seems to happen, doesn't it?
Yeah. And Cate, you've got a horse in the race. You've talked before about your Hobart investment property. We've got Hobart and Darwin, the top two markets for rental growth in both houses and units, but very, very different markets. You wouldn't say that the Darwin is at the beginning of its run. It's either towards the back end or perhaps it's the middle, but Hobart is definitely just in that green shoots sort of way. So does that number maybe say that there's activity that we'll see in the data and it could have a good couple of months?
Look, it's hard because we can't necessarily draw a parallel there. Hobart's a really interesting city, and there could be a surge of workers going down there. We could see a growth. I'd really love to look at, productivity and some economic data to understand what's taking more renters into Hobart. Because the last time we saw a surge like this was when they were trying before they buy, or they were escaping and going down during the lockdowns. But it's really strong, and we've felt it ourselves. We get that lovely surprise when the property manager says, "Oh no, you definitely need an increase. I'm going to suggest X, Y, Z." You think, "Gosh, that doesn't sound sustainable to me." And then you have a look at some of the other properties that are similar that are renting, and you think to yourself, "Okay, well, it's had growth and we'll charge market rent." We've certainly been the beneficiaries of that.
When you think about the situation that we're at the moment, Dave, where we have had a couple of years of solid rents, we talked a little bit about APRA potentially entering the chat with, the percentage of investment loans being, there or thereabouts to the point where they jumped in before. But the market seemed a bit different to the last time there was intervention. It seems like the housing market, certainly the rental market, is much tighter and I would kind of say much risky to be tinkering with when we have vacancy rates so low. A lack of investor participation now is probably going to put upward pressure on rent. So is that a problem that you think APRA and the policymakers face?
It's a good point. I wonder how much they would factor that in, how much they believe in less investors buying properties, how much of a material change it actually makes to the investor stock numbers. It could factor into their thinking. Yeah, look, vacancy rates are so low. Catality's numbers have come out for December. They said the vacancy rate moved from 1.5 to 1.6, so it's still super low. So it could play into it. I just actually ran our numbers, and I'll get them happening monthly now. But we actually had a huge increase in investor purchases this year at Property Planning Australia. So our total number of purchases was up 12% year on year, but the investor purchases jumped from 22% of our total purchases in 2024, which is lower than, I guess, the national numbers.
Yep.
It jumped sharply up to 46% of all our purchases this year were investors.
Wow.
So it was a really big jump, yeah.
That's interesting, and you don't often get to see private company data. So thanks for letting us sort of behind the curtain. I know that's something that we try and do at MCG because we have a huge amount of data coming through. We're a sort of a high transaction style business, and that paints an interesting picture. And I suppose the data is showing that investors had a pretty good year, but for you to jump that much, it's interesting because I suppose it denotes that there's pockets and there's markets within markets, and wherever your guys are from and going to, they're active.
Yeah, that's right. It surprised me actually, that jump, and I guess it is that theme, isn't it? People are more stretched. We've got interest rates that are a bit higher. So the decade average for interest rates, I think, I've got it somewhere, but it's about 2.5%. We're now sitting at 3.6%. That feels like it's more like the new norm, doesn't it? The 3-year bond rates are around 4%. So suggesting the new norm might even be around 4%. So people have to get used to this new normality. And we're seeing this shift where, okay, I can't upgrade. I don't want to upgrade. I'll renovate. I won't spend the big dollars, but I'll play in that lower quartile and therefore I'll invest rather than upgrade. And that's certainly what's played out in our, 20-year-old client base.
And are you seeing a similar thing as well, Cate? Because obviously you service owner-occupiers and investors, and I've spoken to you before where sometimes it can be actually majority investors and then they can just whittle down to 5%. So where do you feel seat of the pants they're at the moment?
Once we had credit calm down, because I had a period there where I was almost all owner-occupied because credit for investing was so tough. But after 2019, things loosened up again. And I generally sat at about 30-70, 30% investors, 70% home buyers. It's switched. This year it's been 70-30. So we've certainly seen that come through. I've had a lot more full service, full search, interstate investor type briefs, and it feels like it's become the new norm.
Interesting. And let's go to listings, because I suppose you're our person on the ground, our canary down the mine with listings, because I suppose you sort of see that more palpably than Dave and I. How does it feel in your little corner?
I was just going to jump back to one little chart, and that is gross rental yields. And just very quickly, what I wanted to point out there was we've seen Perth, Adelaide and Brisbane diminish. That's because their rate of growth hasn't kept up with their rate of rental growth. So even though the rental figures look pretty good on that chart that we were just referencing, their capital growth has surpassed that. So we've seen, obviously, that's what determines gross rental yield. And Melbourne is now sitting above Adelaide and Brisbane and Sydney. It's always been a little bit above Sydney, but it hasn't always been above Adelaide and Brisbane. So that was an interesting one to note. It just highlights the power of the pace of growth.
Yeah, it's funny, isn't it? You see that the pace of rental increases and you kind of think, how are the yields shrinking? But it's just, if the capital growth is there, that's how the equation works.
Exactly.
And just rounding out rents before we move to listings in terms of the 12-month numbers. So rents rose 5.2% in 2025. So that was slightly up on 2024 rental growth of 4.8%. So I think I might have got that one wrong when we come to our prediction episode.
Me too.
I think I expected them to fall slightly. But just to give that longer view, which we've run an episode on decade of rents and how that had been under less than CPI for a decade. So really rents have been playing catch up, but boy, have they played catch up. So the last 5 years, rents have risen at an average annual rate of 7.4%. That's a big number, you know, for people who've been renting over that period, long-term renters. Whereas the previous 5 years to that, the average rate of rental appreciation was only 1.2%.
Yeah, that paints the picture, doesn't it? That's a very, we were used to that. That was just that's what rents did for a decade. But this is new.
So it's been a great period for, you know, property investors who've been, you know, owned property prior to the last 5 years, because it's been pretty strong capital growth and very strong rental growth.
I think without that rental growth, just based on the capital growth we've seen in a lot of markets, it wouldn't be making sense. Everything would be so heavily negatively geared. It'd be only the high net worths that could stomach that negative cash flow that would be participating.
Yeah.
Very true.
All right, listings. Cate, you first. Yeah. What are you seeing? Is there enough stock?
Yeah.
It sounds like the data is sort of saying no. We're below our pre-COVID long-term average by quite a way.
Yeah, well, what I was experiencing at the coalface is not really aligning with what this chart's showing, because the chart's showing national, and I'm only experiencing Melbourne and Vic regions. But when you go down to the chart that shows specific capital city and regional volumes compared to last year, it does tell the story. And I'll pop this in the show notes, but interestingly, new listings, Melbourne and Sydney had more than last year. And we felt that. When you have a look at total listings, everyone was in deficit other than regional South Australia, which is really intriguing because it had some very strong growth. But the true story is sitting there with Darwin, Hobart, Perth, Adelaide and Brisbane. They've got, particularly Brisbane, Perth and Darwin, they've got enormous deficits there when comparing total listings for this year versus last year, and even their new listings, they had a bit of a deficit. So yeah, the market was definitely carried by those heavy hitters, and it looks like it was driven by a supply-demand ratio that was in favour of the vendors, not the buyers. Hence, we've seen prices surge.
You like a good acronym, I know. So there's FOMO there. There has to be. It's just so tight. So the competition is, everyone wants to get it, especially around Christmas. It's such a milestone, right? You're talking about doing the deals on Christmas. Like, people emotionally anchor themselves to, I need this by Christmas. I don't want any presents. I just want this investment or this owner-occ to go through. That's all I need.
Yep. It is an interesting time. It's that invisible finish line, and there is a lot of panic and a lot of FOMO for some buyers. But I do wonder, the chicken and egg scenario, are those who are desperate to purchase people who had already sold, or are they looking forward to 2026 with some optimism around getting their next home? I don't know. It's a really interesting dynamic that you get when we get to the 24th of December.
Yeah, we're already into January, and I have to say, from our side, we've been smashed this week. People are back to work now. I don't know. I haven't looked at the data to see, is it early, is it late? But it is. Okay. people are wanting to do things.
Their life admin too, Mike. I've had a lot of clients this last week. We've read in your your strategy guidebook, and it says that we should be looking at depreciation. You know, what should we do? Enter Mike, fling them your website, tell them how to have a read. But people do the life admin stuff at the beginning of January, so I'm not surprised that you are busy as a quantity surveyor.
Yeah, we've actually had more leads than normal, I would say, this time of year over the last 2 weeks, even since Christmas, like Christmas to now, more people, reaching out, wanting to obviously work out their mortgage strategy or buy a property. So that's interesting. It's interesting. I think years go in waves. Like, you know, some of those COVID years, people were just burnt out at the end of the year and they just wanted to stop and not do anything. And you get those periods, I think, where, you know, it's the year goes in a flow and has a feel to it that affects most people. And some years people don't want to start going again until the end of January. But this is certainly one of those ones where, you know, people have gone, okay, I want to get my finances in order. I want to look to invest. We've certainly seen that in our business over the last few weeks, which is interesting. I don't know if either of you two have felt that. You said you felt that in your business too, Mike, like more activity than normal at this time of year.
For sure. I think I heard a realestate.com executive say that Boxing Day is their biggest day of the entire year. So, I mean, that is obviously, okay, we've gone through the Christmas rush. You know, nobody died, no family members punched each other, hopefully, so that we can relax and de-stress and plan, okay, well, like, what do I want this year to look like? Or, you know, my New Year's resolutions are about to tick over. Let's have a look at that investment, or let's finally upgrade because the place isn't fit for purpose. So, yeah, it's obviously a big seasonal thing, but that doesn't always equate to action, but it does seem to at the moment.
Yeah. Look, I think one thing, just back on listings, I think total listings numbers is a good example of why property prices keep rising in our country, and it's part of ultimately that supply issue that we have in Australia. So, you know, we've got inventory is 20% below the 5-year average. So total listings, we've got 20% less properties for sale than the 5-year average. Despite over those 5 years, population is growing year on year. So there's more and more people moving to the country, living in our country, looking for shelter, looking to buy or rent. But the amount of properties available to purchase is 20% below the 5-year average. That is exactly why prices keep rising. If you look, you know, for people, and, you know, there's a lot of people who are always skeptical or worried prices are going to plateau, flatten, you know, go backwards, I'll hold off looking to buy. Until that is fixed, prices will keep rising. Until listings keep rising proportionally to the amount of new people in the country that are extra people that are looking for properties and shelter, we're going to continue to have an issue with supply, and therefore prices will keep rising.
I see that as a bit of a two-parter, Cate. So what the government always talks about is supply in terms of build more, build more, build more. We need to build more. Absolutely true, and Dave shared some of the reasons why. But I also kind of think that there's a structural inefficiency to the way that people live. There is a bit of a mobility tax, and when people are feeling like this house is not necessarily optimal, they're not necessarily racing to put it on the market because, firstly, they've got to find something in a low stock level environment, but they're paying the price with the stamp duty and, you know, just legals and real estate. Those are all kind of baked in. So for policy makers that are trying to solve this problem, is that a lever that maybe we'll see some intervention on?
Well, we've talked about stamp duty, and we have.
Cate doesn't like changing stamp duty. She wants it to stay.
No, I think it's a huge burden. You know, when we look at it as a percentage, and contrast what it was 20 years ago to what it is today, it's an absolute barrier. I think we can do things differently, and we know that stagnation has been a real problem in terms of people sitting tight on land or dwellings that they don't necessarily need, but being reluctant to sell because of the total cost just being too much for them to bear. You know, they're looking at in a lot of cases, retirees looking at their wealth equation saying, well, it will cost us X dollars to exit this property. We've got to calculate stamp duty and agents' fees and marketing costs, and we're trying to do this downscale, but it's eroding so much for us. We're actually better just sitting tight for a bit longer. And we've also got adult children who aren't moving out when they used to. So yeah, there's so much space and opportunity for reform, but it's a really tough one to tackle.
Yeah, and it's a long-term policy change. It doesn't happen overnight if you're going to transition, for example, to land tax.
That's right.
Instead of stamp duty.
How do you have consistency nationally? We saw what New South Wales tried to do. It's a really difficult thing to lead the chase on, and then they reversed it, which I thought created even more complexity.
Yes, there's one thing we can probably guarantee. It's that a politician somewhere is going to have a ham-fisted approach at something, and it's going to cause us all plenty of things to talk about on this show. Before we leave the listings, we don't really talk too much about, say, regional NT, because it's a bit different compared to other states. For example, in New South Wales and Victoria, we have these super satellite cities, whereas the vast majority of West Australians are kind of Perth-centric. But you've highlighted some extreme turnaround in the numbers.
Yeah, and I need to put a caveat around that, just as you have, Mike. We're talking about a very unique data set. It's a massive expanse of land with much smaller communities, not the same satellites and big regions that we have in some of the other states. But it's a crazy figure, and I even looked at it and wondered if it was a misprint. 104% more new listings this year than last year. Now, that's a massive number.
In regional Northern Territory.
That's right.
Yeah.
And people getting opportunistic and saying, I've been waiting for 20 years for this. It's here. Let's list our property for sale. Because when I did a deep dive into the activity that's taking place in Darwin, it's a very finite number of suburbs that are impacted by this crazy growth. I mean, Darwin is naturally a smaller capital city anyway. We talked about this a few months ago. It's 150-something thousand people. That's a small city by any measure. But that number in regional Northern Territory, it was a shift that definitely caught my eye. Is it behavioural? Is there an attitude there among many, many vendors who are saying, let's take advantage of these conditions? That's certainly what it looks like.
It's a weird old place up there, and I think Dave and I were talking about, we like to add, some testosterone to the chat, talking about military intervention and, explosions and that sort of stuff. But Darwin obviously is a strategically important location, but there doesn't seem to be the South China Sea fracas that, was sort of dictating the chat in 2025. It's now sort of going to other parts of the world. But gosh, it's a hard market to understand, really. And of course, we did do that deep dive and we did our best to do that, but it just continues to surprise.
It does. Yeah, very much so.
Let's go to sentiment. Interestingly, if we were to throw this into ChatGPT, I think it would sort of say, people think everything's a bit too expensive, but it's going to go more expensive. Well, what do you reckon?
I looked at this chart and thought, to use Dave's words, it's a bit anemic. There wasn't a lot of excitement jumping off the page because the month-on-month and the year-on-year changes were pretty tame. But I highlighted time to buy a dwelling. And the reason I did that is we've had in 1 month a 4% shift, which is notable. But when we look at January last year and then January this year, they're almost identical. And the reason why I'm fascinated by that is if we cast our mind back to a year ago, we were very excited about the prospect of rate cuts. And it was almost an absolute certainty. In fact, we had our first one in Feb, we had one in May, we had one in August. And so people were quite excited. There was a bit of FOMO because they're thinking, well, if rates drop, house prices gallop away, will I miss out? What's really interesting is fast forward 1 year to now, we've got everyone saying we're going to have a rate increase. It might even be in Feb. And yet we've got the same number showing there on this sentiment index for time to buy a dwelling. That says that we've either got our head around it, we think it's business as usual, or we really don't care as much about interest rates as people thought we would. I thought it was fascinating.
That is interesting. And you've got something that you can share in the show notes about the interplay between periods of high capital growth and interest rates. But Dave, I'm keen to hear your thoughts. I suppose for 2025, the big standout metric is the house price expectations index. Even though it's softened a little bit, we're still talking about 25.3% growth over a year.
Yeah, look, I think with the rate reductions we've had this year, that's pushed that up, that 25%. And we've seen strong capital growth across a lot of the capital cities, even though it's a mid-tier capital cities. And I get the information on the states to just see the difference between the states. So this is really driven by, for example, Queensland is 176. So that's the most bullish state. They're still thinking prices have a fair way to go. So that's interesting. I guess there's that sort of positive feel because of the Olympics coming up. Obviously, net interstate migration is quite strong for Queensland, whereas Western Australia and so Western Australia is the biggest cooling expectations, or second biggest cooling expectations, still high, 164. And the least bullish is the one where I think it's sort of at the tipping point is South Australia at 155. So you get those sort of deeper insights into what's happening with the perspectives in those states. What's also interesting in the time to buy a dwelling index, so we've had that 4% move there, but the buyer sentiment is strongest in actually, it's a good time to buy a dwelling. New South Wales, 97, Victoria, 95. So no surprise, the states where the two capital cities have had the weakest growth over a fair period of time, whereas it's the most pessimistic, again, in these states that have had the strongest capital growth. So Queensland's 80, Western Australia's 80, South Australia's last, again, it's 78. People just think, prices are very high and unaffordable in South Australia. The last point in that time to buy a dwelling index is in age brackets. No surprise, the 18 to 34-year-olds with the first home buyer boost, they're up at 103%. So they are the strongest by a long way in terms of thinking it's a good time to buy a dwelling, 18 to 34-year-olds.
Well, they've had a good year with the things that have been brought out to support them. Interesting, you believe, like across the board, that the time to buy, the house price expectations index is up because of some of the rate cuts. But Cate, you were sort of sharing some data that looks at the growth during different interest rate cycles, and we even had the good professor sharing a story about how he was arguing with a colleague to say that, well, no, like if interest rates go up, then house prices soften, but that is not borne out in the data.
We did an entire episode on this. Yeah.
Yeah, you'd be brave to argue with Mr. Kalizos.
Absolutely, yeah. And I thought this was an interesting chart, and I haven't seen Cotality put something like this up in quite a while, but it was just showing, and I'll throw it in the show notes, it's showing all of the years back to, looks like 1982, and, the capital growth that they've enjoyed each year. And then when we think about, those key events, whether they're global or local or economic, some of the times that we would have thought house prices would tumble, they've been flying. So, for example, in 1988, when the cash rate finished at around 15% for the year, home values surged 31%. Or in 2021, in the middle of a pandemic, values jumped almost 25%. So it just goes to show that it's not a clear relationship, and you can't just correlate with one data point. There's always so many moving parts.
So, Dave, I suppose if we don't get a rate cut and we actually have a rate rise, that does not necessitate that prices are going to soften at all. In fact, it could do the other. What are money markets' expectations for interest rates?
Well, I think I touched on that the 3-year expectation
3-year bond
for bond rates is around low fours.
4%.
Yeah, a bit over 4%. So we're at RBA's at 3.6 at the moment. So 2 rate rises over 2026 would take us to 4.1. So like that's a 3-year view. But obviously they're expecting rates will be a little bit higher. I actually made a note of a few economists' predictions. So Westpac and ANZ expect an extended hold on rates. That's their current view. AMP, they expect to see the cash rate remain as well at 3.6 in 2026, but swing back to rate hikes in 2027. CBA economists are now flagging the possibility of a 25 basis point hike this year if inflation doesn't ease back into the target band. And NAB also have 1 hike penciled in for the second half of 2026. So that's a bit of a perspective of what the economists at the banks are thinking when they put the blindfold on and throw the dart at the dartboard.
One thing the economists, I suppose, are looking at is oil. That'll be a very interesting one to watch because the US actually produces a lot more oil than Venezuela. I think the reserves of oil in Venezuela are there. It's a specific type of crude as well. Apparently, it's very thick. And it requires extra levels of production to turn it into the things that we know and love. But America is actually fairly well geared for that sort of processing. So, I mean, it does seem mad that we've had a kidnapped president and a country saying, oh, we're going to run it and we're just going to take over their oil production. I mean, people sort of say you can't make this up. I mean, you could. Obviously, if you're a gifted enough writer, you could make it even weird, but it does seem very unusual place to a place to occupy planet Earth at the moment.
That's true.
I saw. Do you remember going to the movies and there was that ad? It's like you wouldn't steal a handbag, you wouldn't steal a car, so don't pirate the movie. I saw a hat. You wouldn't steal a Venezuelan president.
Right. Okay. Yeah.
I'll get you one for Christmas. Well, that was before this unravels into madness, which we are actually going to save for the live event, which is coming up in March. Amazingly, guys, we've got I think about 10% of the tickets are already sold, and we haven't necessarily gone out to everybody. So I think we can chuck that into the show notes, and we're going to be live at the Latrobe Valley Golf Course, 5th of March. Is that correct?
Latrobe Golf Club, in Alphington, as opposed to Latrobe Valley in Gippsland.
It's not in a valley? Right.
It's not.
I don't want people to overshoot the runway.
I was actually at Luke's rep cricket carnival, the Victorian Metropolitan Cricket Carnival, yesterday, and Luke's rep team, ECA, Eastern Cricket Association, won their semi-final. So they're in the big fight. And I was scoring next to one of the dads from the Southeastern Cricket Association. He's a follower of our podcast and recognised me from the podcast and some of our videos or something. So it's a small world. So, looking forward to meeting more of our listeners at our live event in February. Should be fun. Yes. So good to hear that and the tickets are selling.
How to get tickets, you can either jump onto Instagram, you can have a look on our website, propertytrio.com.au. There's links there, or just reach out to us if you need us to send you a link. We'd love to meet you.
Yeah, looking forward to that one.
One or two quick last notes. So trimmed inflation rose 3.2% in the 12 months to November. So that just came out. That was down from 3.3, so that's good. Heading in the right direction.
Nice surprise, wasn't it?
It was. So we need that under 3% if we want rates to stay where they are. But annual services are still sitting at 3.6, down from 3.9 over the last 12 months. Goods is 3.3, down from 3.8. So still heading in the right direction, but not where it needs to be. And then one last point I just wanted to make was in the month of December, Perth median on houses overtook Melbourne's. So Melbourne just keeps sliding down the ladder down to 5th place now, and Adelaide's only only $21,000 behind. So
we do need to look at the houses to units ratios, though, and you've mentioned that so many times, Dave.
This is houses, though.
Right.
Just houses.
I stand corrected. Wowzers.
Yeah. So Melbourne, I always think of that graph, that moving graph, which would show the cities move up and down over 40 or 50 years. And Melbourne's on one of those downward slides. It's not, but
it's moved to New Zealand somewhere.
Highly affordable.
Well, one more data point. We did get something that tumbled out of the ABS in December, and that was the September unemployment figures. And this is another key measure that the RBA are always watching, because we get fixated on inflation, but unemployment is another one that they keep a very close eye on. And happily, I can say there's nothing to see here, folks. But there's stability there, and that was a bit of a concern, and probably still remains a concern, but right now it's looking pretty good.
People are working a little bit less hours, though, I think. I haven't looked into that 100%. Obviously, there's unemployment and underemployment.
Yeah, it remained at 5.9, but that's a consistent thing that more people are underemployed than they wish to be.
Yeah, look, I guess actually if those numbers trended negatively, as in if unemployment increases and hours worked decreases, then we're less likely to see rate rises. For our listeners to understand.
Well, you did do a deep dive on RBA and its charter on, maintaining full employment and inflation and those sorts of things. So that's a good way to dive into the nuances of how that interplay affects policy as well. So I think we'll call that a show. December, the month that was, and 2025, the year that was. We're looking forward to partnering with you through 2026. We'll give you all the news. Keep you updated every month. Plenty of listener questions and some really interesting topics coming your way as well. So thanks, Dave. Thanks, Cate. We'll see you soon.
Good to see you.
See you soon, guys. We'll be reviewing our predictions from 2025 very soon, perhaps next episode, and seeing how we all fared.
Ouch.
Sounds good.
See you guys.
See you later.
Have a good one.